supplier. So this is another one you look at the right of substitution, is if it is not economically viable for your supplier to substitute, it destroys their profit-making ability, then you would say that the asset is implicit in the contract. So in your analysis, if a supplier would substitute, and by the way, it also talks about in the standard, if a supplier substitutes the asset because it's broken or it has to go in for maintenance, that doesn't count. Because obviously that's a contractual obligation, maybe to have an asset working. So we're looking here to say, all right, if it's not economically viable, so if I lease a car to a client for a period of 5 years, and it's not economically viable for the vendor to change the car, it doesn't make any sense. It'll destroy your profit margins. Then you would probably say there's an identified asset. And of course, the times that you might change the car, occasionally you buy a car, it's a lemon, or it's a dud, right? The percentage of cars that are duds is relatively small. But a certain percentage of cars, you know, there's something wrong with them and you just want to get rid of the darn thing. So you can't use that as a justification to say that is not a lease. So obviously they're going to change the car if it's a dud or if it's a lemon. But if you'd say, well, economically, the supplier expects to make money to give this car to you, and you're going to keep it for the period of time, then it's not a lease. So then it would be a lease. So the right of substitution is key. When you talk about a capacity portion, for it to be an asset, a leased asset or an identified asset, it must be physically distinct. So if you talk about an oil pipeline, would that be a leased asset? Would that be an identified asset? Yes? A pipeline. Well, it depends. I guess you don't have a lot of oil in Pakistan, right? Do you have any oil here? Very little, right? What's that? Okay. Well, the oil places that I worked with is obviously Saudi Arabia, and also if you work down in Nigeria. So the way it worked, there was an oil pipeline that went from Cameroon, Chad to the ocean. Chad, Cameroon, the ocean. And what happened with that pipeline is many different oil companies would drill oil, and you put your oil in the pipe, and when you put your oil in the pipe, you put a separation gel. So if I'm British Petroleum, I put in X million barrels of oil, and when I put my oil in, I put a gel. So at the other end, when that gel comes out, you know, okay, this is BP's oil. The next one is Shell's. So if many different companies use that pipe, would that be a lease? Because it's not physically distinct. In Saudi Arabia, there is one oil company, Aramco. So if you only have one oil company that uses all of the output, it's physically distinct. That would be a lease. So for it to be a lease, it has to be physically distinct. Does that make sense? So how about if you have say that there's a flight that goes between Karachi and Dubai, and you sign a contract to always have seat 1A. So on that plane, that's your seat all the time. Would that be a lease? So you have seat 1A on any time that airplane flies. Is that a lease?
Does it remain empty all the time?
It's either you use it or it remains empty. What's that? Well, right now we're just talking about an identified asset. This one's a bit more tricky because the seat is one aspect, but to make the plane fly, you have a common engine, a crew, common toilet. You probably don't have your own toilet, right? And if you go on a flight, you have to have a bathroom, right? So you would probably say in this situation, you'd probably be saying, well, is the seat enough to be an identified asset, or does the seat have other aspects to make it work? So you probably would say a seat by itself on a plane is not an identified asset. You probably have a service from the airline. Because an identified asset would probably require your own cockpit, your own equipment to make the plane fly. When it comes to an office building, it's a bit different. You probably say in an office building, a shared bathroom doesn't mean it's not a lease. Because a shared bathroom to an office building is not considered to be as substantive as, say, a cockpit to a plane. So when you have a lease, you have to have a physical distinct area. You can't share unless it's a minor aspect. So generally, it's okay to share a bathroom. It's okay to share an elevator. But if you have, when it comes to an office, you have your distinct door, there's your office, that's separate. So, question 1, is there an identified asset? The answer is no. We don't have a lease. Question 2 is substantially all the economic benefits. So for it to be a lease, you need to get the economic benefits to that asset, or the lessee does. That means the primary and the byproducts. Okay? If there are payments from third parties, the key here is, do the payments relate to ownership or use? There's a difference. So for example, in Romania, I have some land I want to build houses on, and I bought the land right at the edge of the city, and right now the land is farmland. So what I do is I rent it out to farmers. And in Europe they have something called the CAP, the Common Agricultural Policy. And the way it works in Europe is you get paid money for the amount of land that you have, farmland. Now, we have to look at the rules. If the rules say the money goes to you if you farm the land, or does the money go to you because you own the land? In Europe, the rules are written in such a way that the money goes to you if the land is farmed. So if I rent out the land to a farmer, but I keep the subsidy from the government, then the farmer doesn't have all the economic benefits if the subsidy is linked to actually farming. Therefore, it would not be a lease. If, however, the subsidy is based simply on ownership, it doesn't matter whether the land is farmed or not. If the government says, if you have land, we're going to give you X amount per hectare. So in Europe, we get 200 euros per hectare, at least in Romania. In Western Europe and France, they get more. There's a two-tier system depending upon the country you're in. So if the subsidy relates to ownership, that's different. If it relates to usage, that's different. So solar panels. I'm not sure how it works in your country, but in the United States, if you put solar panels on your roof, the government will give you a subsidy because you purchased them. So if the landlord keeps the subsidy, that's fine, because the subsidy is based on ownership, not based on usage. That's the key thing there. So that's one thing you've got to look at carefully. So in a lot of these, the devil's in the detail. So if you answer no to any of these questions, you don't have a lease. The third thing is who directs how the asset is used. And I'm going to talk about this in a bit more detail. If you ever go to Lebanon and you rent a car, and when you rent a car in Lebanon, the car comes with a tracking device, a GPS. And Lebanon geographically is located in a challenging area. It's next to Syria, right? And the problem that you have there is Syria has a bit of a war issue, or there's issues in Syria. You know about that. So if I'm a car rental company, I don't want the car to go to Syria. Also, there's parts of Lebanon that are also not considered to be very well safe. So what a car rental company will do is they will put a GPS tracking device in the car when you rent the car. And if you drive the car past a certain line, you know what happens? The car is frozen. You can't drive it anymore. It's blocked. You have to call the car rental company. The car rental company will come out, and they have to move the car back into the zone it's allowed to be in, and then unblock it. Now, if a car has this type of device in it, does that prevent you from using the car how you want? Yes, but why do they do that? If you were to live in Lebanon, and assuming you were just a regular person that worked for a bank or an accountant, you probably wouldn't drive to those areas anyway. So a normal educated person probably wouldn't drive to those areas, because you realize if you do, your car might get stolen or might get blown up or something might go wrong. So if you would own the car and not go to those areas, the fact that the lessor or the owner of the vehicle puts a device in to protect it by not going to those areas, this is what we call a protective right. So a protective right is different than a substantive right. So a protective right is where the supplier says you can't use the asset this way. So in Saudi Arabia, if you rent a car, you cannot take the car to Yemen. As you should be aware, there's problems in Yemen, right? And obviously, to a car rental company, that's too risky. If you owned the car in Saudi Arabia, you probably would go to Yemen either. So what we need to look at in the contract is, do those restrictions actually prevent you from substantive use of the asset, or do those restrictions actually more protective in nature? Now, I'm also an examiner. I'm an examiner for the Chartered Accountants of Ireland. I have a US GAAP exam. And one of my previous questions I wrote was about a supplier of coffee equipment to a hotel. And the question was it a lease or not? And the key aspect for delegates to consider was the fact that the equipment required you to use the vendor's coffee. So you couldn't use coffee from a third party because it had those, and it was designed specially to only use the vendor's coffee. And the question is, could that be a lease or not? Well, it's actually a difficult question, as most of my questions usually are. When you look at the analysis there, IFRS focuses generally on, and I made some notes here, on the output, not the input. So usually in IFRS 16, the direction tends to be output focused. So I did some research on this, and it's not very explicit, but the view of the Big Four that I work with is if the vendor restricts the materials that you use from an input angle, their view is you should only analyze the restriction from the output perspective.
But the output is also restricted then.
No.
If you're using raw material from, if you're using the input from a specific customer, from a specific vendor, then the output, the copy would be the same. It won't be different than if you have used the ingredients from any other vendor.
Correct. Okay, and the scenario that I had is you have some equipment in a hotel, and obviously the coffee companies make their money in the consumables, like Hewlett-Packard, right? Hewlett-Packard makes its money in the consumables. So what we would say is from an output point of view is you can control who has a cup of coffee, who doesn't have a cup of coffee. You can move the machine around to different rooms, to different conference rooms. So you probably take the perspective from an output perspective. Look, if the coffee is crap because it has bad input, that's a valid point. But the perspective of the big four that I work with, and it's not very clear in the standard, if the restriction is on the ingredients that you need to use when you buy the equipment, that probably doesn't preclude it from not being considered to be a lease, because the emphasis in the analysis is more on the output. Who gets a cup of coffee? When do they get a cup of coffee? So that's what we tend to find, is the analysis is more on the output. Because I've had a number of situations where people ask about, I have to use a specific material or equipment from the supplier or the supplier's consumables. So what I've seen, if the supplier has a restriction on the consumables, we generally don't consider that to preclude you from saying it's a lease. Because I argue the other way. I did a bit of research on this, and that's not really considered to be who directs how the asset is used. So the standard emphasizes the output. There was the right, and here's some examples in IFRS 16, the right to change what type of output is produced. When is the output produced? Where do we produce it? And how much do we make? The quantity. So the emphasis on who directs it, it's output focused, not input focused. See, these questions get messy, right? Does that make sense? So emphasis on the output, not so much on the input. So, question 1, is there an identified asset? If there is no identified asset, there cannot be a lease. So identified asset means it's distinct. Question 2 goes on the economic benefits. Do we get all the economic benefits, or substantially all? And the third question is, who directs how the asset is used? And again, this concept of a protective right. So we're trying to say, is the restriction going to hinder how you'd use the asset? And the way I look at protective rights is, if I bought the asset myself, would I drive my car to Syria? Probably no. The typical person in that market. But if I bought the asset myself, and the typical person will use the asset a certain way and they can't, then that's not protected. That's substantive. It's judgment, right? IFRS is a lot of judgment. Yes?
Do we still quantify this word substantially? What yardstick we are going to use?
There is
Because previously we used to take certain opinions about that substantially in the legal dictionary would mean 80% or 90%.
Well, there is no percentages in IFRS, as we know, of course. So I think, yeah, this can become, in certain scenarios, this can become messy. So the way I think a better approach is to apply more common sense. And so what I would be looking at is, if a typical market participant who had that asset, if the restriction is on the input side, I think the consensus, it's not explicit in the standard, but the consensus of the big four is, if the restriction's on the input, that doesn't matter.